The fear of missing out. What do you do when you miss the dip? That's what we're going to talk about today. Welcome to Get Invested, where it's not just about growing our wealth, it's about growing and improving ourselves. I'm sharing how I build market-beating stock portfolios using a growth-focused mindset, and we're doing that here starting with just $100. If any of that sounds interesting to you, hit that like and subscribe button, follow along. Last week, we invested $20 into Alphabet, Amazon, McCormick, Netflix, and Teladoc Health respectively. A total cash investment of $100. In that time, our stocks have generated a market gain of $9 with 7 cents in dividends. That's a 1-week return of 9.06%. Thanks to the benefit of fractional shares, we didn't need to spend the full share price to buy into any of these stocks. While we may not own a full share or have voting rights, we still receive the appropriate percentage return on our money, no different than if we owned a full share. You can see that here in our unrealized gain column. In that same period of time, the S&P saw an increase of 1.57%. So we spent about 10 minutes putting these trades in last week, and we're currently ahead of the market by more than 7 percentage points. Our goal was to beat the market without day trading. So far, our performance is on target. So what caused that jump? Last week, we got some positive news on vaccine trials, and that triggered a bump of optimism across the market. At that same time, Teladoc completed the acquisition of one of their competitors, helping them increase their market share. I want to be clear, I did not time that investment intentionally though. I was aware of the merger, but I did not follow close enough to know it was going to execute last week. This was unexpectedly positive performance across the entire portfolio. Considering the current market volatility, a similar swing of negative news could have changed direction on any of these. In which case, I would have expected to see Amazon, McCormick, and Netflix do well if new lockdowns were announced. My thinking as I add companies to the portfolio is to diversify in such a way that we see positive returns regardless of the direction the market recovery goes. Either way, we're covered. Because along the way, I've learned that if you're not prepared to be wrong, you're not prepared to be right. So how does that mindset apply to investing? How am I confidently making investment decisions knowing I might be wrong? When I first approached investing, I always heard the classic and obvious advice of buy low and sell high. But if you're not already in the market and you see articles pointing out we're at all-time highs right now, like this one, stocks jump, NASDAQ powers to record highs as investors look past virus concerns, you're in a tough position. The dip happened back in March. You missed your chance, and now you have to sit it out and hope for another dip or buy overpriced stocks at their peak. So what if there are no undervalued companies? What happens if you're late to the game and buy stocks at their peak? Well, there's actually a study that looks into that. Meet Bob. He is one of the world's worst investors. Just take a look at his strategy. His timing is terrible. He strictly invested $100,000 in a broad market ETF at various times between the years of 1970 and 2020, a time period of 50 years. Each time he made the investment, it was right before the market would drop 20% or more the next day. He is the guy that sits on the sidelines until the hype is at its peak and finally jumps in, only to be left holding the bag while the market crashes. And if we look, we can see in 1973, he put in $100,000 right before the Arab oil embargo. In 1987, he put in $100,000 right before Black Monday. Market dropped 23% the next day. Then, he put another $100,000 in right before the dot-com crash. Markets dove 46% the next day. Same thing happened before the subprime mortgage crisis. Another $100,000. Markets dove 54% the next day. And once again, this past February, another $100,000 invested right before the markets dropped 34%. But see, with all of this bad luck, through the power of compound growth, his investments would actually be worth $5.7 million today. See, these early investments, even though they dropped immediately after he made the investment, they still had 25, 30, some even 50 years to appreciate over time. Even if he jumped in only at the dot-com crash, that $100,000, even if it dropped 46% the next day, still would have reached a new peak by that same time 5 years later. Similar to his investment right before the subprime mortgage crisis. Had he just waited roughly 5 years, his investment would actually be at a new peak. So, with that theory in mind, we know that if we just constantly invest in companies that demonstrate resilient growth, whether the market is up or down at the time of our investment, with a little bit of patience, the math is actually on our side. And this is how we avoid FOMO. Whether the market is up or down, we take emotion out of the equation by investing in these companies consistently. Letting time control our signal to buy also smooths out volatility. A similar strategy is dollar cost averaging, where you buy a stock anytime it's below your target price. Here's a quick example. Imagine a scenario where our objective is to purchase 20 shares of company XYZ. Scenario 1, we're all in. Day 1, we buy 20 shares at $60 for a cost basis of $1,200 or an average price of $60 a share. Scenario 2, we dollar cost average. Day 1, we buy 10 shares at $60 for a total of $600. On day 2, the stock price drops 30%. So we buy 10 more shares at $40 this time for a total of $400. Our total becomes 20 shares at $1,000 with an average share price of $50 per share. Now, when the price eventually rebounds to $55 on day 3, our investment in scenario 2 is up $5, even though we initially purchased the stock when it was at $60 on day 1. Meanwhile, our investment in scenario 1 is down $5 because the average cost of those shares is $60 when the current market price is $55. If the market is up and it goes up more, our initial investment will appreciate. If the market was up, then it goes down, our next purchase of that stock will be cheaper than our first one, so we'll be effectively buying it at a discount. This is called dollar cost averaging, and in the long run, it works in our favor as long as we expect the stock to go up in the future. This is why I never liked the advice of buy low and sell high. Instead, I prefer buy whenever you have the money to invest. Sell whenever you need that money. Well, we have $100 waiting for us in the portfolio, so let's invest it. This week, we'll be adding 3 new companies. First, let's diversify more into international markets. I'm going to pick up C Limited, ticker symbol SE. C is a rapidly growing e-commerce giant in Southeast Asia. They are a segment leader in 7 markets, specifically Taiwan, Singapore, Thailand, Indonesia, Vietnam, Philippines, and Malaysia. This covers a huge emerging market of 585 million people, about the population size of North America. Their market cap is $54 billion. Imagine if you could get into Amazon stock when it was in the hundreds instead of the thousands. That's our hope with C Limited as their web services continue to scale up across Southeast Asia. The other 2 companies will be testing our theory on avoiding FOMO by jumping in well after a lot of the hype has died down. The first one is going to be Apple. They're making strides in AR and are expected to release their first 5G phone later this year. I know everyone has an iPhone, but I'm pretty convinced once the 5G phones come out, we'll see another resurgence in that product. Next one is Zoom. Zoom saw a stratospheric rise as it was the most popular video calling service during regional shutdowns. A lot of hype around this company has started to die down as other tech giants like Google and Facebook launch competing services. Most people watching this probably think it's far too late to invest in Zoom, especially at its current price. But I believe they actually still have room to expand in the market as video conferencing continues to become more mainstream. The remaining $40 will be spread across our portfolio. This is one of the primary reasons I like the M1 platform. Their Pi system makes it easy to allocate your funds across all the companies in your portfolio with just a few clicks of a button. We've got our trades queued up and ready to go for tomorrow's market open. We'll check in on the progress next week. If you found this video interesting, hit the like button. Also, feel free to share your thoughts in the comments. If you want to join us on this investing adventure, hit the subscribe button. We'd love to have you. Links to this episode's portfolio are in the description below. And if you want to get notified each time we add a new video or new stocks, make sure to hit that notification bell. Thanks a lot. Have a good week. Stay safe and get invested.